What a week! Snowmageddon slowed down our local economy, and then the National Association of Realtors reached a settlement setting the stage for how we will conduct business in the future. Now, please know that leaders within the industry are already digging into how lenders can assist buyers and realtors within the new framework being created. So much more to come on that, I promise. Now, additionally, we saw stronger than expected inflation data, which caused mortgage interest rates to increase last week, bringing the average 30-year fixed rate mortgage rate to just above 7%. Here's a quick recap of last week's mortgage market news. February inflation data topped the charts. You guys know that. Inflation data is the biggest concern for mortgage investors and the Federal Reserve. And last week, we received two key inflation reports, both coming in slightly higher than expectations. On Tuesday, we saw the Consumer Price Index, or the CPI report, showed that inflation on the consumer level increased slightly above expectations. Now, there was very little market reaction to that report. However, we saw then the Producer Price Index, or the PPI report, that showed inflation on the producer or wholesale level increased well above expectations for the month of February. We saw a 1.6% increase versus estimates of 1.1%. This had a negative impact on the mortgage markets, causing interest rates to rise. Now, it's important to note that the PPI report is key to the direction of inflation in the economy, because the inflation from producers generally trickles down to consumers, right? Both reports together indicate that inflationary pressures still exist within the economy. Now, the Fed meeting, right? This week we have a Fed meeting coming up after a week without any clear indications of a slowing economy or declining inflationary pressures. The markets are focused on this week's Fed meeting. At the conclusion of their meeting on Wednesday, the Fed will make a public statement regarding their view of the U.S. economy, and they may indicate or include hints about the timing of their first rate cut. There is no expectation for the Fed to cut rates at this meeting, as I'm sure you know, and the Fed futures market is currently predicting a little more than 50% probability that the Fed will do their first rate cut in June, and a very high probability that it will happen in July. Now, the Fed is not only worried about cutting rates too soon, right, as that could cause bond markets to rally and inject cash into the economy, but also increasing inflationary pressures. It's a wild cycle, right? And they've got a balancing act. So we will keep you posted. We're still sitting in, as we said, the low sevens in terms of interest rates. If we have spoken about a refinance, we are still watching it closely for you. If not, let's talk before rates drop and the market is inundated. So no matter what, let's have a conversation. If you're thinking about buying or selling or doing something, it's a great time. There's a lot of opportunity in the marketplace, but we need to be strategic about it. So have a great day. Call me with questions.